Namaskar. Greetings, folks. Today, I'm going to talk about a very popular trading tool called RSI, the Relative Strength Index. It can be a very useful tool in your trading and investment toolkit. Whilst being a very popular tool, often people make mistakes in making a proper use of it. In this video, I will cover the conditions in which this tool can be put to best use. But before we do that, a quick word of disclaimer from me. This video is only for information and educational purposes. It should not be treated as an investment advice. For any investment decisions, please do your own research and take full responsibility of your own decisions. So, without further ado, let's get straight into the subject. First and foremost, a little thank you to the person who created this indicator. His name is John Wells Wilder Jr. He was an American engineer who got interested in trading and created several indicators. This RSI was first published in his book called New Concepts in Technical Trading Systems in 1978. So it's pretty old, but it has survived the test of time and it is still being used as one of the very popular indicators by the trading community. So thank you, Mr. Wilder. So, what is RSI trying to tell us? Perhaps the clue lies in the two keywords, relative and strength. It is trying to measure the relative strength or conversely the weakness of the price action relative to time period. So it considers the 14 recent most periods. So if you're looking an hourly chart, then RSI will calculate of 14 hours. If you're looking at a daily chart, then it will calculate of 14 days. So the word relative is with respect to the recent most 14 periods. The word strength signifies how strong the momentum of price action is in a particular direction, whether it is going upward or downward. The strength tries to calculate whether it has overdone either to the upside or downside, and it helps us to start thinking of initiating an action. If you are in a long position, then it might indicate that it is time to take some profits, or if you are thinking of buying a particular stock or indeed add, then it might help you with that as well. Now let us look at how RSI is calculated. I appreciate if maths is not your thing, but trying to understand how it is calculated will give you the conviction that you need in using this tool in your trading strategies. And if you're worried about how it will be calculated while you do your analysis, please understand that the charting platform you use will do the calculations for you. The reason I'm sharing the formula with you is so that you understand how it is calculated and why it represents strength or weaknesses of price action in recent periods. So calculating RSI is a two-stage process. In the first step, what you do is from the 14 periods, and by the way, this 14 periods is just a default number that most platforms use. You can increase it to whatever number you like or decrease it to a smaller number. If you increase the number, then the movement will be slow. Strength or weakness you get will be more conservative. But if you reduce the number, then it will be more aggressive. It will move quicker. For now, let us stick with 14 days as the period. In step 1, you separate out the days in which price made gains from the days it made losses. Then you take the average of gains and average of losses separately. Then you divide average gain by average loss to get a number. Let's call it RS. Then in second step, you calculate RSI as shown in the formula. 100 minus 100 divided by 1 plus RS. RS is the number that you calculated before. One thing to note and remember is that RSI will always be a number between 0 and 100. The formula is designed in such a manner that it will never get out of that range. A reading of 100 will mean extreme strength. You may call it overbought condition. And a number 0 will indicate extreme weakness, meaning oversold. Now let us look at three different examples. For all the three examples, I have assumed that we are looking at a 14-day price action. In the first example, let's say we get 8 days of price going up, say at an average of 10% gain, and 6 days of price going down at an average of 7% loss. Then the calculation will be as follows. RS will be 10 by 7, which is 1.43, and RSI will be 100 minus 100 divided by 1 plus 1.43. So 100 minus 41.15, that gives you a number of 58.85. In example 2, a different scenario, 5 days of price going up at an average of 3% and 9 days of price going down at an average of 9%. Now note here that you've got more days when the price is going down, and with a higher percentage, you get a number of 24.81. So in comparison to example 1, it is a smaller number, which tells you that the price action has been weak in this period. A third example is the other way around, which has got 9 days of price going up at an average of 8% and 5 days of price going down at an average loss of 2%. That gives you a number of 80, which is very high, which means the price action is very strong. Okay, as I said, the RSI always oscillates between 0 and 1, 0 meaning extreme weakness and 100 meaning extreme strength. Let us now look at some charts and see how RSI is utilized in our day-to-day trading decisions. So I've got a price chart. It is chart of Tesla with a daily time frame. Let me just expand so that candles are slightly more clearer. Most platforms will provide RSI in some form or the other. You have to just get used to your own platform and see how RSI can be plotted on the chart. On this platform, it is part of the favorites, and at the bottom here you see a number of indicators. RSI is here. It shows me plot of RSI moving alongside the price. Now, when I click on this, it shows me various parameters that have been used to calculate RSI. In this case, they have taken 10. I was talking about 14, so let's make it 14, length 14 periods, and apply it to the closing price. You can apply it to open price, high, lows, or any other combination available. So let's apply it to close and say done. You will also notice there are two horizontal lines, one at 70% and the other at 30%. So this bluish line at 70% and this orange line at 30%. These are the typical values. If the RSI reading goes below 30 or above 70, then it is getting into the range of oversold or overbought. Some more conservative traders use 20 and 80 instead of 30 and 70. It is up to you what value you want to use. But the key point here is that if the graph of RSI goes above 70 or 80, if you want to use 80, then it is in overbought territory and you might want to start taking some profits. And if it goes below 30 or 20, as the case may be, then it is in oversold category. Then you might want to either start a new position or want to add to your existing position. So that is one way of using RSI. However, you have to remember one thing, that if the price is in a constant uptrend or a downtrend, then the readings could be misleading. That if it is in a strong uptrend, the price can continue to go up, showing you the RSI readings in overbought territory. Okay, so that is the risk. Likewise, if it is in a strong downward trend, then RSI might show you in a oversold territory, but it might continue to go down. So you can actually get caught on the wrong side. RSI is very useful when the price is actually going in a range. That is, if you were to use it by itself as an indicator. My recommendation is always use any indicator with other things. You need at least 3 or 4 good reasons to make a decision to buy or sell. Now, RSI can also be used in a slightly different manner, which is better than the simplistic use that I talked about earlier. Let's say you look at a rising trend of price and then try and see whether there is a equivalent trend on the RSI. In this particular case, for the price that I have indicated here as rising above, you notice that the RSI indicator has been going sideways for a very long period of time. What it means is that it is not going up with the price because it is already in overbought territory. The thing to note here is that when price makes newer highs but RSI starts to break down below the overbought territory, that is when you know that it is likely to diverge in a different direction. So that is when you take the decision. Let me see if I can see an overbought situation here as well. So between this point and this point, the price has been in a short-term downtrend. But if you look at here, whilst the price is going down, the RSI after touching 30 has starting to go up. What it means is that it is perhaps a good time to start adding to your position or becoming a buyer, because it has touched the overbought territory and starting to go up even while the price was making a new low here. If you use RSI this way, it can show you divergence of a current trend before the price actually starts moving in opposite direction. So it is kind of a leading indicator in that sense, but you've got to use it very carefully. Now let us look at another chart. This is a chart of NU Holdings, and it is again a daily chart. I would like to draw your attention to this downtrend here and corresponding downtrend on the RSI plot. As the price makes waves down, the RSI also makes wave down. But at this point in this region, the RSI is indicating that it is already in oversold territory because the RSI value has gone under 30 here. The point that you have to note here is that when the RSI breaks this trend line, which is a mirror of the price trend line, at this point you can effectively start adding to your position or start a new position as a buyer. Typically the RSI indication will happen before the price makes the break in the opposite direction. So this is another good example. If you look at the recent most price action here and the corresponding plot of the RSI, you can see that RSI is now in the overbought territory above 70%. But here, whilst the price is still going up, the RSI is coming down just under 70. So this could be an indication, a leading indication that this price is ready to break this short-term trend here and take a swing down. But as I said earlier, you've got to use these things with care, because when there are strong trends in one direction, then the RSI seems to not work as well, because it then stays in the overbought territory or oversold territory for a long period of time. Okay, so you've got to exercise due care and apply some other tools and indicators and use the information from the fundamentals of that particular stock to come to your trading decisions. Hope you found this session useful and gives you enough to start practicing on your own. But as I always say, please exercise caution because you're dealing with your own money, and make sure that you look at multiple indicators as well as fundamental information about a particular stock that you want to invest in. Please do provide your feedback and comment. And if you're interested in any other topic, please let me know. I will try to research, learn, and share with you. Thank you. Namaskar.